So we're at an interesting place in the rally, and we got a really big week coming up. How do we look to you right now?
Yes. So as a whole, I mean, the market looks vulnerable. The bull-bear sentiment is very much moved towards the bulls. Valuations at nearly around 30 times for the NASDAQ, 20 times for the S&P, with interest rates, at around 4%, and the Fed and the economy slowing, but seeing signs that inflation might be reaccelerating. So I think it's pretty tricky, and it's going to be very stock specific.
Why are we where we are then? How did we get here? How did we get here?
Yes. So I think a lot of us have been asking this, right? Because the Fed raised rates so rapidly. The Fed raised rates so rapidly, shouldn't that have just slowed the economy and kept the market down? But I think what happened is that we had this infusion of about $400 billion into the banking system in March. That bailed out the banks while people were taking money out of deposits, putting them into money market accounts. That, I think, was the foretell of money getting into the credit markets, bringing credit spreads down, which loosened financial conditions. The market saw this and said, oh, if credit spreads are down, multiples should go up. At the same time, the Fed was having an impact on slowing inflation, right? We've been seeing decelerating inflation almost everywhere in the economy. And so the market also saw that and said, oh, Fed rate cuts ahead. I mean, they're still priced in, for beginning early next year. And so they thought, well, the multiples can go up. The issue is that the market itself has a reflexive feedback loop, and the market going up actually starts to loosen financial conditions along with credit spreads, which, I think puts us in a tricky place. But I think that's how we got to where we are today.
Maybe we were just miscalculating all along how strong we were going in. Thus, we're going to be better off on the way out. And that's why we are where we are.
I think that is part of it as well. Absolutely. I mean, we've gone into this tightening cycle with a tighter economy than we've had than I think we've had really probably ever historically, right? The labor market is so exceptionally tight. Goods like autos were at production lows, right? Housing inventory is very low. The housing market tight now because of higher interest rates as well. But we've gone into this from such a tight place. The labor market, again, so tight that it actually, you need a lot to upset that. And instead, we actually got an infusion of capital.
Well, then why isn't that good enough to justify where we are? I mean, when I asked you that, you said exactly as if, kind of throwing cold water on this idea that it's not justified that we are where we are.
Well, so I think the issue is that a lot of the ebullience in the market has actually gone to companies that are, fundamentally are nowhere near justifying their valuation.
Are you talking like mega cap tech?
Certainly mega cap tech is part of that.
You don't
Absolutely.
You don't think they're in any way justifying their valuations? All right, let's go.
I always say there are certain mega cap tech companies that I think could justify their valuations. There are others that are probably quite stretched. And actually, even outside of mega cap tech, I think the valuations are worse, right? You get into areas like enterprise software, other growthy companies, and valued anywhere from $10 billion to $100 billion. Valuations are very high. So what you've had this year is just massive multiple expansion without the earnings growth to justify it in most cases.
Yeah, I know, but don't you, in the kind of names we're talking about, because of what's happening with AI and the narrative around that, you're willing to pay higher multiples because you're betting on the growth that we think is going to develop. You think we've put too many chips into the center of the table on some of these names, and it's just not going to come to fruition in the way that we think? I
do think so. Look, I've said this before. I think Microsoft could potentially grow into its valuation. I've said that. Certainly, Nvidia at this point, if the demand continues, it will grow into its valuation.
It's only 50-something times, I think, Nvidia is, and right, it's cheaper now than it was before. It had this massive earnings bump.
Yes. Look, Nvidia could grow into its valuation. We know that there's been significant front-loading of demand, so we'll see how long that continues. So I think it could be tricky, but could they get another couple quarters of very strong growth? Yes, maybe it's longer. But I think that it's a harder call here, just because we don't know what the end state of demand is going to be, because the Nvidia chips are used for training models. Once you train a model, you can actually reuse those chips for the next model, and we don't know how much pull forward there's been. I'm not making a bear call on the stock right now, and actually the companies I would pick on the most would be non-profitable growth companies, or companies that are only profitable on stock options, that are trading at very high valuations, that actually are not showing the kind of growth, the earnings growth that would justify them.